Everyone knows they need to save for retirement. Roth IRAs are a super popular vehicle to do it, especially among the YouTube crowd who tend to be pretty financially savvy. And with good reason. Roths have great tax benefits, but here's the thing. You can make too much money to be able to contribute to a Roth. I find that a lot of people miss this. They start out being smart, making Roth contributions, and over time, their income rises, and they never think to check if they've gone above the limits, which can create a lot of problems. So, what is that income level where you literally aren't allowed to make Roth contributions anymore? I'll break that down today, but fear not. Even if you're over the limit I'm about to tell you, I'll also give you 2 ways you can still get Roth money into your retirement accounts regardless of how much money you make. First things first. How much can go into a Roth IRA in 2025? So what's the maximum? The IRS didn't move this number from where it was in 2024. Lots of times they inflate the numbers each year due to cost of living adjustments, as you can see from the chart. Contribution limits started way back when the Roth was introduced in 1998 with a max of only $2,000, and they've risen over the years. The last bump we got was another $500 in 2024. No such luck this year. So the contribution limit, the most you can put in is $7,000 for 2025. If you're over the age of 50, you have access to a catch-up contribution. That's another $1,000. So you can get a total of $8,000 a year into the Roth. That's what we're talking about here. Now, it's important to note, subject to the income limits we're about to talk about, that it's per person. These are IRAs. IRA is individual retirement account. So if you're married, you can get a total of $14,000 that can go in, or $16,000 depending upon your ages, assuming you both have Roth IRAs. There's some special rules about this. Even if your spouse isn't working, you can make a spousal contribution in some cases, but that's a different video for a different day. So now we get into the income limits. This is something called the Roth IRA phase out, and it's a phase out because it's literally a range of incomes that determine how much of your contribution is phased out. So if you're below the income levels that I'm about to give you, you can put in the full boat, $7,000 or $8,000 in a year depending upon your age. Once you pass that bottom threshold, the bottom number, the amount that you can put into the Roth goes down bit by bit as your income rises until you hit the cap, the top number. I'll put it up on the screen here so you can visualize what it is that I'm saying. So for this year, 2025, the phase out starts at $150,000 a year for single filers. If you're below that, you're good to go for the full amount. For married filing jointly, it begins at $236,000. Now, these numbers I'm giving you are for what's called modified adjusted gross income. That's similar but not the same as your adjusted gross income, or AGI. In an effort to not put you to sleep, we're not going to go through the calculation here, but know that the IRS is looking at modified adjusted gross to determine your eligibility on this phase out. And so starts at $150,000 a year or $236,000 depending upon your filing status. And the higher the income, the lower the contribution you can make until you can't make any contributions at all, which happens at $165,000 for single filers and $246,000 for the joint filers. If your modified adjusted gross is above that level, no Roth contribution, except for what I'll show you here in just a minute. Now, before I do that, big warning here. You'll notice that on my cool little chart, I didn't list married filing separately as a status. That's because if you're married filing separate, you're basically in the Roth penalty box. If that's the way that you file, and there are a lot of reasons why it might be, the Roth contribution income cap is $10,000. Yeah, if you make more than $10,000 a year and you're married but filing separate, the Roth is off limits to you. There's no contribution that can be made. To me, this is one of those things about our tax system that make little to no sense, but nobody ever asked me how we should design the tax system. So I'm just here to give you the information. If this is you, Roth access is basically shut down. Hey, as we're going over all of this stuff, if you're looking for someone to help put together the right retirement plan for you, someone that knows all of this stuff and can help, check out the links in the description. You can book a time with me to talk about how we can help you with your retirement planning. Now, I've teased it a few times, but even if you're over the limits that I just went over, there are still 2 fairly easy ways you can get money into a Roth account. The first one is through your company retirement plan. Now, I know this is not IRA specific, but if your company offers you a 401k or a 403b, there's a good chance that there's a Roth option available to you inside the plan. More and more plans have been offering this year by year over the past few years. There are a couple of big benefits here. The first one is contribution limits are much higher than in an IRA. You can put a total of $23,500 into your 401k or 403b, and all of that money can be Roth, assuming that you have a Roth option. If you're over 50, the catch-up is a big old $7,500 for 2025, which means a total of $31,000 a year in Roth money. And to make things just a little bit more complex, there's now an additional catch-up that applies to these accounts starting this year if you're between age 60 and 63. Your catch-up contribution isn't $7,500, it's $11,250. So for those folks getting close to retirement, you can get $34,750 into one of these plans. Now, even if you work for a small business and they have a simple IRA, which is a very common retirement plan for them, Simples now also offer a Roth option. This was a change that was made a couple of years back, and the limits aren't quite as high as the 401k or the 403b, but still quite a bit higher than the regular old Roth IRA. And so here's the thing. Those sorts of accounts, company retirement accounts that offer Roth money, have no income limitations. You can make as much money as you want. There's no phase out. Doesn't matter what your income is. And you can get that full amount in as long as there's a Roth option available to you in your plan. So if you haven't checked this out, check it out immediately, because it's a great way to stack up the Roth money in your retirement. So that's the first way. And while it's not specifically a Roth IRA contribution, as I said, it's still Roth money. It goes in after taxes. It grows tax deferred, and it's tax-free when you use it in retirement. If you've made it this deep into a Roth IRA, you don't need me to tell you how important Roth money is in retirement. Just do it. Check out whether you have the option or not, and if so, start filling up that bucket. And so now let's get on to the second way. Maybe you don't have a work plan, or maybe you have a work plan, but you still want to save more on top of it. Enter the backdoor Roth conversion. Now, this is different than the regular Roth conversions that I talk about on the channel a lot. In those, we're taking money that's been living in a traditional IRA for a while, paying tax on the whole thing, and converting it over to Roth. You have to do that because in order to do a conversion, you have to pay tax on any money that hasn't yet been taxed. And that money that went into the traditional IRA was typically tax deducted when it went in. But what if it wasn't? That's what we're talking about here. Now, stick with me because this is a little nuanced. You can make a non-deductible traditional IRA contribution at any income level. This is saying, I'm going to put this money into the traditional IRA, but I'm not taking a deduction for it. And then you can turn around and move that money over into a Roth IRA. At that point, because you didn't deduct the contribution, you only have to pay tax on any gains that were earned while it was in the traditional, while it was on the traditional side of the fence. Now, lots of folks do these transactions back to back. Like today I put my money into the traditional and tomorrow I convert it to Roth. And in doing so, they didn't have any gains. And therefore, it doesn't create a tax bill. Now, to be clear, this is a full-blown loophole. This is something people figured out that you can do, and there's been talk of closing the loophole, or at least making it more difficult. But as of the recording of this video in early 2025, it's something that's existed for years. And because there's no income limitation to doing things this way, while it's not directly a Roth IRA contribution, for high wage earners, beyond that phase out limit, this is a way to end up with the same result. You just have to jump through a few hoops to do it. Now that you know about income limits to making a Roth contribution, as well as how to use a backdoor contribution if you're a higher wage earner, what do you know about mega backdoor Roth conversions? Mega sounds good. I've got a video on the way. Subscribe to the channel to be notified when I drop it. If you're watching this once it's already been put up, still subscribe to the channel, but you can find that video right over here.